This is the Insight is Capital podcast.
Tom O'Gorman is Senior Vice President, Director, and Portfolio Manager of Fixed Income at Franklin Bissett Investment Management. The views expressed in this podcast are those of Tom O'Gorman and Franklin Bissett Investment Management.
So, Tom, where are the opportunities today?
That's a great question. That's really where the rubber hits the road. The one thing we're doing, and we're based in Canada. We do all of our strategies are from a Canadian point of view for Canadian investors. But the one thing, and I've been doing this a long time, is it's not news that Canada's a smaller economy. It has a smaller bond market. The bond market, plus or minus 1.7 trillion, and in some regards it's narrow in breadth. You have governments, federal governments, provincial governments make up 3/4 of the bond market. The last quarter would 25% would be corporates, and half of that is financial. So it's sort of narrow. It's a little bit smaller, but you just look outside south of the border, and all of a sudden you have a $24 trillion bond market. If you look at the investment grade markets, the high yield markets, which alone are bigger than the entire Canadian bond market. So there's lots of opportunities out there. We focus, anytime we're talking about what we do, is we're trying to find, active positions with low correlation. We don't want everything moving together, and the real way to do that is to look for assets that don't all move in tandem or that are correlated with the Canadian bond market, and that's really where we are focusing now. When you think about fundamentals, still pretty good in the credit space within corporates. Valuations I talked about not nearly as attractive, so much more difficult outlook. And then we look at supply and demand and technical factors, and that's been very supportive for markets. But it's also led to the fact that valuations are that much higher. So a couple of areas. One of the areas that's been very good to us, but it still offers some value, is within some of the high-quality energy names within Canada and the U.S., like Canadian Natural Resources or something like that. We think within financials you can go down in capital structure, with even to the preferred level of the capital structure. So say within a bank you have senior bonds, subordinated bonds, and then preferreds right above the common equity. A lot of the preferreds in Canada are fixed floating structures. We really like that. We don't like fixed for life preferreds. They're very long duration. But a fixed floater, if it doesn't get called at that 5-year call date and it's floating and interest rates are moving higher, that's something we like a lot, because the price of the preferred is likely going higher. At least the coupon that you're earning is going higher. So that's kind of attractive, interesting opportunities there. But, one of the things is we're really just, it's sort of going bond by bond, issuer by issuer, security selection, relative value. We still do like some U.S. high yield, and we have some U.S. levered bank loans in the portfolio. And again, the bank loan side is fully floating rate, so there's no interest rate risk there. It has a lower correlation with Canadian fixed income, as does U.S. high yield. So those are some areas that are attractive to us. And but generally, because of your question is the right one. It's not nearly as attractive, the markets in general, as they have been for some time. And I said this last year at this time, not knowing how good 2017 would be, but we're just that much higher in terms of valuation. So we are going up in credit quality. We are taking taking risk down in our portfolios a bit, and we do have natural hedges, things that we think, should volatility pick up from its historic lows, they will protect the portfolio on the downside. And some of those hedges are U.S. Treasuries, having a net long position in U.S. dollars versus the CAD, especially at today's level. We have hedges within the credit space where volatility is low. So buying options when volatility is low is very cheap. You can pay a small premium, and you have the right to sell that exposure. So there are strategies we can do that protect on the credit side as well. Because we are heavy in credit. We're not as heavy as we were, but we do still prefer corporates over government bonds. But at the same time, these overlay type strategies, these hedges, they provide protection. They also don't upset the underlying portfolio because they all can be done through the use of derivatives.
And your outlook for volatility is that you expect it to return along with possibly inflation?
We are not expecting a big change in inflation. If we are wrong on our outlook that rates out the curve, the central banks will continue their tightening as long as they see fit. That'll increase the overnight rate and it'll pressure the front end of the yield curve. Inflation will determine, along with supply and demand, what 5, 10, and 30-year government bond yields where they move. Our call isn't for inflation. We don't see wages. Wages in Canada are growing on about 2%. They're not nearly strong enough, and that's a nominal growth rate to create an environment where you can go to your boss and say the price of milk is going up, I need a raise, and that just filters through and companies start raising prices. It's really competitive. I can tell you in our business, you're not raising prices. You're not raising fees on financial products at all. So we don't see inflation going up, but that certainly would be a problem. If I'm wrong on that and inflation did become unhinged, that could certainly spell the end of the sort of, I said earlier, the as good as it gets sort of environment we are in today. So, but your real question was about volatility. People have been wrong on this for so long. It's sort of, they've been wrong on interest rates every year for the past 8 or 9 years, and everybody keeps expecting volatility to increase, and it hasn't. I can't predict. I can paint scenarios that would cause volatility to go higher, but I can't predict whether they're going to come true. What I want to do is position the portfolio such that we feel it gives us the best opportunity to deliver, superior risk-adjusted returns over the long term. So I still own corporate bonds. I don't own as much of the higher beta stuff, than we did, 12 or 18 months ago. But against that exposure, we have these hedges and things like that, because at some point volatility is going to go up. It'd be hard pressed to think this environment's just going to continue on, in perpetuity.
Definitely.
So we sort of welcome that. Volatility, I think, is an active manager's friend. I think it's something we can take advantage of. We have lots of capacity and dry powder from which to do that. But inflation could be one thing, geopolitics could be another, something that sort of takes the shine off of U.S. equities, where all of a sudden, there's just, even if it's just technical, where there's no more buyers, everybody is in, and you get some bad news in some context and have some kind of correction there. But that we don't spend all our time trying to pretend that we have a crystal ball around those things. We're trying to think of it, from a portfolio standpoint, how we should be positioned, and and all those factors I mentioned go into that.
Well, Tom, thank you very much. That was very informative, and thank you very much for sharing your insight.
Sure. Thank you very much, Pierre.